oh my goodness, they're going to approve the ETF by Wednesday. Oh no, now it's going to be by Thursday. Oh, now it's going to be by Friday. Bitwise is not putting and spending money on commercials unless it's going to get approved. So it's going to get approved. All these whips are just to make you get anxious and nervous and try to whip you out. It's either trying to get you to put leverage back on at 25x, or it's trying to make you panic and get wiped out and dump. Fed is not going to be cutting 6 times in 2024 like the market has priced in. We've already seen rates start to jump up.
The ETF approval is taking us on a wild ride. Is Bitwise's commercial spree on CNBC a secret signal? And guess what? The Fed isn't planning a 2024 cutting spree like the market imagined. Rates are flexing their muscles already. Now, let the crypto maestro, Gareth Soloway, unravel these enigmas.
You have Bitcoin still trading within a range. Now, I want to point out one thing. Coming into this week, you saw whips up and down on Bitcoin. All right, you had, oh my goodness, they're going to approve the ETF by Wednesday. Oh no, now it's going to be by Thursday. Oh, now it's going to be by Friday. And then in the middle of that, we had, oh my gosh, they're not going to approve it. And this is all BS, right? I mean, again, they're going to approve the ETF. It's just a matter of when. And I want to say the reason why I'm so confident that they're going to approve at least one of the ETFs, and probably a few of them at minimum, is because literally I'm watching CNBC every morning now this week, and there's Bitwise commercials for the ETF on TV on CNBC. So again, Bitwise is not putting and spending money on commercials unless it's going to get approved. So it's going to get approved. But the question that I have is, which way does it go? And that's what the charts are here to tell us, right? So very clearly, we're stuck in this channel. I love the simplicity of this channel. I don't have a bunch of crazy stuff all over that is confusing here. It's a channel. We know our upside target still remains at 48 to 50,000. That would be best case scenario. The downside, if we take out this area down here, we then have downside to 38,000. That's your first big support, 38K. If that breaks, you then have support at 30,000. Now, there's been lots of people, I mentioned 30,000 just a couple days ago or even yesterday in this stream, and people were like, oh, it's never going to 30,000 again. The more people say that, the more I actually think it will, because there's a tendency for the market to flush it to levels where people get whipped out of the trades, right? So again, I have no clue where it's going to go. I don't know, but I do know that market sentiment is a inverse indicator, meaning that the more bullish people, the more people that pile into a trade, the less additional people there will be to buy the good news, thus sell the news events. That's why we saw, for instance, NVIDIA. I still remember vividly. NVIDIA comes out after hours with incredible earnings. One of their last conference calls jumps to $520 after market. It then sells off from there down to like $460 by the next day or $470. It was a sell the news event. Their earnings were amazing, like blockbuster, but everyone had piled in anticipation, and therefore people started to take profits once the news was out. Okay, so we know our levels here. Again, to the upside, we have the 48,000 level, all right, 48 to 50K level on Bitcoin. Those would be your two levels on either side of price. The way I work is very simple, guys. It's price dictates action. Okay, meaning that if we break above 50, we start looking at what the next target is. If we break below the 38 level, we start looking at 30. If we break below 30 at some point, even if it's unlikely, we then start to look at the next level. Doesn't matter what you and I think is going to happen. The market couldn't give a crap, frankly. It's about the levels. When one breaks, you look to the next one. Very simple. Okay, let's go to the gold chart, which again continues to kind of jumble here on things. We're not seeing a whole lot of action here. Gold continues to be just down slightly, trading at 2043. This, again, is the weekly chart, I believe. Yep, the weekly chart. So, again, I'm just pointing out here that we're still below this level. I know everyone wants their update on gold every single day, but honestly, there's not a whole lot. And look, by the way, same thing on Bitcoin.
Let's highlight some of what Gareth said. The ETF approval dance had us all on our toes, but Gareth cuts through the noise like a crypto samurai. Bitwise's commercials on CNBC. A crypto crystal ball, or just a flashy ad campaign. The charts are speaking, revealing Bitcoin's current tango within a channel. But let's not be fooled by the market theatrics. Gareth's got a straightforward approach. Price dictates action. Whether it's the tantalizing 48 to 50 dream or the ominous plunge to 38, we're letting the charts lead the way through this crypto maze. And now the quick detour to the golden realms. The gold chart, much like a mysterious labyrinth, keeps us guessing. Gareth unveils the hidden patterns and subtle movements that could influence the crypto kingdom.
All these whips are just to make you get anxious and nervous and try to whip you out. It's either trying to get you to put leverage back on at 25x, or it's trying to make you panic and get wiped out and dump. That's all this action is. This is classic action by the algos that are like, hey, whoever's over leveraged, we're going to hunt down your leverage and get you out of the trade. That's what they do. So this is why leverage is honestly one of the worst things you can do as a trader. It's what, honestly, traders that have very little money are more apt to use leverage. Leverage creates more losses, and therefore traders that are poor stay poor. This is what it is. It's being consistent and growing. Like, you could start with $1,000 account. If you start with $1,000 and you compound, let's say 30% a year, which again, in the markets, that's a great return. But in the crypto markets, it's honestly crappy, right? I mean, so to a lot of you guys, you'd be like, oh, 30%, what the heck, 30% a year? But compound that year over year for 10 years, see what number you come up with, versus what most people will do is they'll blow up their account after 1 or 2 wins, making 100%, they'll blow it all up and have 0. As we look at the jobs report, we see that the jobs came out better than expected. Now, remember, ADP yesterday, better than expected. We saw that better. We saw jobless claims lower, less people filing for unemployment. So you know what happened today? Non-farm payrolls confirmed it, that the jobs market is better than expected, or better and stronger. What does that mean? It means the Fed is not going to be cutting 6 times in 2024 like the market has priced in. We've already seen rates start to jump up. Interestingly enough, I just read an article last night that a huge trader put about a $600,000 options trade on the yields, that if yields would, or essentially by today's close, yields would jump to 4.1%. We're almost there right now. Great job by that trader. Whether they knew the jobs number ahead of time, I'll leave that for you guys to discuss. But again, non-farm payrolls, 216,000. Again, we expected 170,000. That is a monstrously better number than expected. Unemployment rate, we expected 3.8%. It came in at 3.7. So let's face it, the jobs report shows and confirms that even if the other data continues to show stress in the system, we are not seeing it translate into people losing jobs. Now, as I've said before, I still expect eventually jobs to fall off a cliff. If you go back to 2007, if you go back to 2000, what do we know from history? And this is the key, guys. History gives us a guide. It doesn't necessarily mirror it, but oftentimes it rhymes. We know that. And jobs, once they start to kind of roll over, they go slow at first, and then they fall off a cliff. Essentially, once employers that are believing that we're going to have no landing or a soft landing finally lose hope of that, they start laying off in mass. And that, again, is eventually what I expect to happen. Okay, so what we're going to do next, guys, is go into the charts. Where is the market trading? Let's take a quick look at that, all right? Now, if we go to the SPY, we are lower on the SPY, but honestly not that bad. Initially, the S&P was down fractionally going into the number. We then dumped on the spiders about $2 to $2.50. That equates to a 20 to 25 point S&P drop. We have now recovered to only down, get this, guys, the SPY is only down about 50 to 60 cents. That's a good recovery. That is a very positive sign. Maybe good news for the economy is starting to finally be good news for the markets. I don't know. Let's watch to see how things trade today. In terms of levels, we went over this level yesterday, right? So essentially the markets, if you're a technician and you're looking purely at the data, at the charts, which is what I try to do, I might give you my outlook for the 12-month period. But again, really, if you want to know what the outlook is for the next 1 to 2 weeks, you look purely at the charts, not clouded by anything else. And the answer is very simple. What we look at right here, right? So we have a market that goes up on the S&P about 16% in a straight line. This is just your run-of-the-mill correction at this point, or pullback. 16% up, classic retrace. We can look at Fibonacci ranges, whatever it may be, no big deal. But essentially what we have here is we have this high here and right in here, and these two things align, right? Which tells us that you could still pull back to about 458 on the SPY. And honestly, it wouldn't be that big of a deal. You would not all of a sudden be like, holy cow, we're collapsing. Oh my goodness, what's going on? It's if we get below there, like I said yesterday in the game plan, that you start to become concerned. But honestly, right here, even if we're down today again, and this would actually be very rare to have this many down days in a row. In fact, I think on the NASDAQ, you have to go back down to 2002 to find the last time we were down 5 trading days in a row. So it's been a long, long time.
Gareth Soloway returns with more financial thrillers to decode. Leverage, the trader's double-edged sword, gets a reality check. Gareth spills the beans on why over-leveraged traders often find themselves in the poorhouse. It's a cautionary tale for crypto warriors navigating this volatile landscape. But the real showstopper? The crypto community's dance with the job market speeds. Non-farm payrolls dropped a bombshell, beating expectations and sending shockwaves through the crypto cosmos. Unemployment rates doing a little cha-cha as well, adding a spicy rhythm to the financial dance floor. But hold your crypto horses. Gareth warns us about potential job market cliffs based on historical rhythms. As we peek into the market charts, we find recovery vibes, signaling potential good news for the economy. Will the SPY's dance with $50 to $0.60 be the rhythm we've been waiting for? The crypto street roller coaster is far from over. Subscribe, hit like, and join us as we navigate the twists and turns of the crypto universe together. The adventure continues, and we're your guides on this thrilling journey through the heart of Crypto Street.